being too early is a risk. That's why sometimes, in as much as there's the first mover advantage, one of the key things that personally I like to engage is the second mover advantage. Meaning, the first person that moved has entered the market, he has, passed the test, he has seen the risk. If he was going to fail, he will fail, I won't fail. But if he failed, I'll be able to learn what made him fail, then I'll be able to build on that to not fail. Then if he succeeded, I will see how he succeeded, I'll copy and paste what he did to succeed and improvise on top. So sometimes first mover advantage has its risk. So personally, I think it's also wise to be the second mover because you can be able to improvise and improve on what the first person did. So, the masterclass basically is to show you all what most fund managers would not tell you, how to be able to raise funding at some stage in your business or your startup. So we're going to run through what I have for you briefly. Yes, so before we start, I would like to, before you listen to me, you need to know who I am basically. So I've been in the financial space for quite a while, for about almost a decade now. Started as a Web3 investment analyst for a private equity firm. And at some point, I graduated to become like a technical analyst. So in 2021, I founded Zwala Capital. It's an investment fund and a global Web3 advisory firm. So we do help startups to raise funding across different boards. So my actual core roots was in Asia where I worked. And if you can see, this our track record as a venture capital firm. We're able to return 8.32x. That is over 800% return DPI, distribution in paid-in capital to our previous investors. And within the last 18 months, we've done transactions that to acquire shares in Figure, Grok, Ledger, D-Matrix, and BitGo. So we're able to straw such deals, and we got LPs to key into such deals. So within that 18 months, we've raised roughly over $70 million. So yeah, that's a bit about me and why you should listen to me. So yes, this is the fundraising cycle. This is how the fundraising stages usually is. So when you first start a company, it's just an idea. Nobody knows about it, just an idea. It doesn't come to life yet, and ideas are quite cheap. All of us receive them. It's execution that matters. So now the first stage of fundraising is the pre-seed funding. That's the ideation stage. That's capital that you need to bring your idea to life. So most times, the source of funding for the pre-seed stage is usually family and friends, who you know, yourself, your family, your close relatives, your friends. That is where the initial funding usually comes on. So once you have that funding, that initial funding, maybe from family or friends or personal income, you are able to develop your MVP, which is your minimum viable product that you cannot take to investors. That we had this idea and we're able to do this, and now we have this particular product or service or particular problem that we're solving. Right now, we need money from you to help us expand what we're doing so that we can reach more people, reach and solve this particular problem that we're solving. So that is where the seed funding comes in. So seed funding is usually termed as like the validation funding, because if anybody outside your family and friends will invest in your idea, it simply means that what you're doing is viable, what you're doing is promising. That is where seed funding comes in. So at more bigger stages, when you now begin to get traction, is when you can now start raising your Series A funding. Usually, the pre-seed funding usually starts between even as low as 5K pre-seed funding, as low as 5K to 10K, no minimum. Just basically what you can use to bring your idea to life. Then the seed funding can go as far as 10M, depending on the kind of market and the sector you're operating in. In traditional finance, it's a lot lesser. In tech, it's quite huge. So the Series A is when you begin to have traction. Let's say you're already dominating a particular market and you want to expand to other markets, say other continents, other countries, is where you need to raise Series A to scale through Series B, C, and beyond. So the final stage of any business is to make profits. Anybody who starts a startup, the dream that you have is either to exit at some point, that's getting acquired by a bigger firm, or you IPO. That is how the founders make money. That's the dream of any founder of any startup, to be able to exit or to do an initial public offering. So most of the deals we do, where I showed you earlier, like Grok, like OpenAI, like Figure, is usually around this area. So we're even seeing a new trend now in VC, where it's not just, most private companies are not even looking to IPO anymore. There's now a very large secondary market where people are selling their shares OTC, a very, very huge market. That usually happens at around here. So that brings me to this. This is Zwala Capital's framework for raising money. This simple 3-step. We're able to compress it and simplify it to just these 3 stuff. The first thing you need to do if you want to raise money is to start with a story. And to start with a story in the sense that you need to understand that what investors are looking at, investors don't have time to start going through long pitch decks or hearing you say different things, because you need to also understand that every investor has an investor. And it's the duty of that person that's trying to invest in you to make returns for his LPs, the liquidity providers that invested in that particular fund that he's running. So it's emotionless. Okay, let me say it this way. VCs are emotionless. They want to make money. But the problem we see, especially in Africa, is the average person starting a startup wants someone that will help them. Nobody is here to help you. Like, the VC wants to make money. He wants to make returns. He wants to invest in things that will make returns. So it's your job as a founder that's trying to raise money to show him how what you're building can make him money. Because in its actual sense, the concept of impact investing comes later when most VCs or most investors have already made money. When they've made money, they can allocate a few $1,000s here, $200,000 here to just, do impact investing, help the community and all that. But the principal aim is to make money. So they don't invest in pity party or emotions or no. They invest in what can make them money. And sometimes we see so many founders who are good at the technical side, who are good at literally everything that makes a company work, but they don't understand how to raise money. They don't understand how to build a narrative around their products and to also speak the language that investors understand. There's a language that every investor understands. Returns, profits. That's the language of every investor. They want profit. So how do you speak that language? How do you build or ride on a particular narrative? Right now, the AI narrative is going haywire. People are, actually, in Asia, we're seeing like young people in India raising insane amount of money. And I don't know whether it's a bubble. It's kind of is. What do you think?
I think it is.
Yeah, it's a bubble, but we don't know when it will burst. So it can last a while. So one of the key things you can do as a founder trying to raise money, because as a founder, you're the only one that know what you're building. You're the only one that know how much effort you put in that particular project. You're the only one that know whether this thing will succeed or not. Investors don't know. They just check whether you are viable for them to invest in you. Simple. The question to ask themselves is, would you be able to return this money back? If yes, would you be able to return this money back? If yes, how long and how much? That's the key things an investor is asking. You're pitching an investor. All he's asking himself is, would this person be able to return this money I'm investing in them back? If yes, they'll be like, how long? How long would it take? What's the duration? Is it 1 year, 2 year, 3 year, 5 year period? After that, they want to check how much potential returns can you bring in. So the language you speak has to center at profits. And you don't lie to investors. They know it already. You let them know what the risk is. You let them know what the current situation is. But show them how they will make money. Show them how they will get back their returns. Are we good? Yeah, does anybody have any question? Any question at all?
Yes, I do have a question.
Okay.
So, how about, people who have an idea, they want to start a business, but don't know how to go about raising capital for their business?
Have you noticed that nobody actually helps someone that needs help. Like in this life, nobody helps someone that needs help. But everybody helps someone that doesn't need help. I don't know if you've seen it. If you are looking for money, nobody is willing to give you money. But if you don't need the money, people are willing to give you the money. So it all starts by having your own basics, like having the basics for yourself, like having the bare minimum running cost that you need. And as a founder, the first thing that you need to learn is your ability to sell. Literally, your ability to sell. Sales is everything. And this framework that we use in Zwala Capital, if we are trying to raise money from other LPs to be able to invest in a particular deal, is very common, but most people don't understand it. It's the 10-4-1. 10-4-1. So it simply means that for every 10 prospects, for every 10 prospects or every 10 leads, meaning, okay, you have a startup, you're trying to start an idea, you look for people who are likely to invest in that particular idea that you have. Or since you don't have the money yet and you want to start a startup that you have an idea, the key thing that you need to get first is to have at least your running cost, your personal running cost. Because, raising startup funding takes time. So you need your own personal runway. So to get your own personal runway, you need to make sales. In any part, you can even go and start selling other people's products just to make money on commissions. And those deals are everywhere. Everywhere. So identify 10 prospects. Out of that 10, there's a probability that 4 will engage with you. Like 4 out of that 10 prospects will engage with you. And there's a high chance that out of that 10 prospects, out of those 4 that are engaged, 1 will land you a sale. And this is what you're looking for. The one that will land you a sale. So imagine reaching out to 100 prospects. And you need to understand that not in every 10 prospects that you get 1 sale. You may not get 1 sale in the first 10 prospects, then you move to the next 10 prospects. And also in show them, you check up on them, you follow up basically. So most times you will get 1 sale here, but there are still 3 other people that are engaged here. You don't leave them idle. You engage them, you follow up, you check back on them. Because in marketing, there's this law that it takes someone to have engaged with you 8 times before they buy from you. So that's where you start from. You start from making sales. You start from making sales of any particular product that you feel you can be able to sell.
Okay.
Yes. Is there any other question? Okay. So this is something that we all need to look at if you want to raise good money. Following the money. There's need to follow the money. Because right now, do you know that right now, anybody can, any smart person, just like you, can start an AI company and it will be a lot easier to raise because money is flowing into AI. So those who were able to spot the AI trend years ago are at the peak of their game right now. So one of the key things that you need to do, one of the problems we see founders do is solving a problem that don't need solving. Like solving a problem that the market does not need. So the first thing you do is go to the market, go through the market, see what the market is looking for, then you come back to create a solution. Not start an idea, then start a solution, then you now start looking for customers for. No. Right now, there's a huge buzz in AI. Go to the AI sector, see what the problem is. Then you now create a solution for that problem that already exists in the AI sector. That way, it will be a lot easier to raise money. Because then you're actually solving an actual problem. I don't know if you get me.
Yes.
So that's what that follow the money simply means. Follow where investors are pouring in money, because capital has a very interesting relationship with returns. Capital is not biased. It's not biased. It's wherever returns is where it goes. Capital loves returns. It loves it. It's like a dating relationship, like a romance relationship that capital and return have. capital will always flow to where there's returns. So follow where the money is, look at that particular sector, and see the problem in that sector, then you come back to build a solution for it. So yeah, is there anything else?
What would you think about returns in Africa? We know that compared to Silicon Valley, for VCs to be able to get returns in Africa, you don't look at 4 or 5 years, the typical years that works in Silicon Valley. To be able to get returns in Africa, you need to wait 9 years. So what would you think about starting an AI company in Africa for Africans? How can you position that to be attractive to VCs?
There are 2 ways I could answer that question. First is, Africa doesn't need AI. Africa needs infrastructure. We need people that will enter manufacturing, that will build roads. We are still battling with electricity.
But then that goes against the principle of following money.
Exactly. But then you follow where the money is in your locality, in your region, where you are from. So now following the money simply means in Africa, let's say even in Nigeria, in Africa, where is the money flowing to? Real estate, oil and gas, construction, energy. So it's from there that you go and see where the problem is, then you come back to build a solution, then you go to the market to raise money from them. So Africa doesn't really, AI is not, we're not there yet, in actual terms, we're not there yet. But you can start building the foundation now. But seeing the rewards of it will be later on. We still need it.
Basically.
Exactly, yeah, pioneers actually. Absolutely, pioneers. Pioneers.
So would you say building AI infrastructure in Africa is the right move?
AI infrastructure, yes. If you have the tenacity to last long. Because a time will come when Africa will definitely need AI. A time will come when we're there. So when investors come pouring in, they will check who has been here. Who are the gatekeepers here? So I mean, that's it. And the best way to actually land the best deals or to make the most amount of money is to be prepared ahead of time. It's not to follow trend. It's to be able to understand. There's this stuff that I do, time capsule, where you're able to check first world countries and see what is working there. Then you come back to a third world country and build that same thing there. I don't know if you understand.
Yeah.
Yeah. So I think that's where that comes in. Your ability to be able to position ahead of the wave. That's where you make money. Because if you are just jumping with the trends, I mean, you're most likely late already. It's the same thing that happens when a stock is about to go IPO. There were those who, many years back have invested in that. So IPO is just like an exit strategy for them. But that's when, the retail start jumping in and all that. Is why they end up picking crumbs. But the big boys knew to have positioned well earlier. Then when the wave comes, they're exiting.
But there's a thing about being too early.
Yeah. No, that's the thing. It's a risk. Do you understand? Yeah. Like if you're too early, you may be wrong. But if you're right, I mean, the returns are astronomical. Definitely. Yeah. The thing about being too early. Being too early is a risk. That's why sometimes, in as much as there's the first mover advantage, one of the key things that personally I like to engage is the second mover advantage. Meaning, the first person that moved has entered the market, he has, passed the test, he has seen the risk. If he was going to fail, he will fail, I won't fail. But if he failed, I'll be able to learn what made him fail, then I'll be able to build on that to not fail. Then if he succeeded, I will see how he succeeded, I'll copy and paste what he did to succeed and, improvise on top. So sometimes first mover advantage has its risk. So personally, I think it's also wise to be the second mover because you can be able to improvise and improve on what the first person did. So yeah, you're right. Being early is high risk.
Money are first movers.
Yes. But look at it this way also. How many pioneers made the first move and lost? A lot.
Yes.
So to be on the safer side is why I'm bringing this school of thought of being a second mover. Because, for instance, OpenAI is already big. They made the move. We're seeing Anthropic. They are becoming big too. That's like a second mover advantage. So like once you just align with where the wave is flowing, you'll be able to, you know, cash out big also.
Definitely.
I don't know if you get me.
I do agree.
Yeah, but like I mean, being the first mover, it has advantages, but that risk factor is high.
Yeah, I think it's similar to what happened with Yele with his first fintech company.
Yes,
Around
yes,
and
yes,
similar what
yes,
happened
yes.
to-
And sometimes why second mover advantage is good is because the market may not be ready for the first mover. The first mover may only be the person that will introduce the product to the market. Then you as the second mover will be the one to win the crowd. Because you'll be able to see the mistakes of the first mover. I don't know if you get what I'm saying. Yeah, so that's that about that. I like that question, actually, bro. About first mover advantage, yes. Do you have any other question?
No.
Oh, okay. That's good then.